So first, the definition of quality differs between investors, but in general, it's true that over extended periods, quality does perform better. And I'll go back to that in a second. But even over that extended 10, 15, 20-year periods, you will notice that you have extended periods where quality actually does not perform as well, or actually significantly underperforms. For example, between 2000 and 2007 or 2008, it was a period where China was building significant infrastructure. For example, mining or other commodity companies. Oil did extremely well, which are usually, these are not quality classified sectors. And in that period of time, actually quality significantly underperformed. So keep that in mind. But really the reason is purely mathematical. The way we define quality is a business that has the ability to generate a high return on capital, but also has ample opportunity to sustain and redeploy capital at incrementally high ROIC, or return on capital. And just mathematically speaking, if a business can do that and grow at least in line with the general market, it will over extended periods generate significantly higher compounding of capital. So the answer is really simple. Okay, so this goes back to my initial answer. 25, and I think part of 24 as well, was a difficult period for quality, and that may sustain in 26 or 27. So even though quality should do better long term, it is by no means a guarantee, and it even doesn't make sense that quality always performs year in, year out. There are other parts of the market that may not necessarily generate as much compounding of capital, but they become significantly attractive, and then they, because of a specific catalyst, end up performing really well. And 25 was no typical story like that, or typical year like that, where you had other segments of the market that did really well. Really for us, it's mostly a question of communication. So we try hard to explain and repeat the message of what we're doing with clients, and really keeping the focus on long-term compounding. The strategy anyway typically holds positions for extended periods and changes few names on a yearly basis. And so really the focus is on maintaining that longer term vision of things. That usually happens in periods where lower quality companies or segments or sectors do really well. We notice that the quality premium essentially diminishes. So I mentioned before, between 2000 and 2008, you had that phenomena, and then you had the GFC, global financial crisis, in 2008. So when we look back at our US strategy, for example, or our global strategy in 2008 or 2009, they really had no premium whatsoever versus the broader market. So that quality premium that we would expect had completely gone. And same thing happened in 24, then 25. 25 was even more exaggerated. Now the premium has not completely gone down to zero, but it has significantly diminished. And that's usually what happens. And the longer the low quality rally sustains, the more that quality premium essentially shrinks. Not only because of the performance differential, but because, keep in mind, quality businesses are constantly compounding capital, or they should be, which also shrinks that premium. So quality underperforming has two effects. One, the pricing differential, so non-quality doing really well, but also meanwhile, the quality business is compounding capital, so that those premiums can shrink really significantly and fast. Now for your second question on the market concentration, that is becoming obviously a bigger challenge for everybody. We've seen, especially in the US market, concentration in either, especially in technology, but in other segments too. So what the market calls the Magnificent Seven, or big AI kind of stories. You do see significant concentration in markets, and that is becoming a challenge for us and everybody else. And we'll have to deal with it. We'll have to deal with whatever market throws at us, and this is, I mean, this is just a reality. But at the end of the day, we are benchmark sensitive and benchmark aware, but we're not necessarily following, or we're not necessarily obsessing over the benchmark. We look at things from an absolute perspective. We own companies that we think are exceptional, whether they're large or small in the market or in a specific index. And we tend to not completely ignore, but focus less on the market concentration and really look at things from an absolute perspective for us. What is the best business that we can own today?